So thank you for this report. You're going to see it first here on CNBC from Mastercard. It shows retail sales up 6%, 6.9% year over year, basically 7% in February. What does that say about the state of the consumer?
Look, I think there's a lot of uncertainty about how the data was going to come in February after such extraordinary gains in January across a variety of different economic indicators. And what we're seeing in the spending pulse data is that the consumer is still out there spending. Almost 7% year-over-year growth in nominal basis is pretty steady spending growth for the part of the consumer, which shows that the consumer has purchasing power, and that's supported by the health in the labor market.
So one thing that's not included in that 7% number are airlines and lodging, hotels, et cetera. Even more strength when it came to those. Airline sales up 15.5% year over year. Lodging up more than 42% year over year. What does that tell us about, the American consumers, not only what they have to spend, but their willingness to spend on credit?
Well, that is an excellent point, right? When you think about that retail ex auto, which is equivalent to the Census Bureau, that's just part of the consumer basket. And if you take into experience-based spending, so lodging, air travel, et cetera, you're seeing a much stronger consumer out there that is absolutely prioritizing their spend on experiences. So it is a consumer that's been able to make choices. And where there's pent-up demand still in experience-based spending, these numbers are impressive.
So, but is this on credit, or consumers, do they have the cash to still spend? I mean, where's this money coming from? When I see a 42, almost 43% jump in hotel stays and a 15.5% jump in airlines, I mean, these are high-ticket items.
Well, they are. So there's a few considerations. One is that there's some rotation of the consumer basket. Consumers are spending more on those items, they're spending less on others. So if you look at things like furniture spending or some of these big durable goods, there you are seeing contractions. So there's a certain amount of reallocation of their basket that's important to keep in mind. The other point around the purchasing power, the sources of spend, there's three. There's income, there's savings, there's credit, and they are all being utilized. Savings and credit have been important kind of buffers or shock absorbers in order for the consumer to be able to spend sometimes in excess of income growth, depending on, the rate of inflation or what their basket looks like.
All right, I know today's report is really focused on consumer spending, but I do want to ask you, some of the volatility we see in the stock market and also the increase in rates, when does that hit this incredibly resilient consumer? Is there a certain breaking point when it comes to auto loans that may cause people to spend less, when it comes to mortgages that may cause people to spend less?
So that is a question I get all the time. People are really trying to figure this out, including in the Federal Reserve, in terms of what's the amount of financial conditions tightening that we would see to really have a break in the economy or have a shift in the economy, particularly the consumer. And the reality is that there's not a magic number. The Fed is going to see it when they know it, when they start to see that transmission of policy into the economy. And it's happening to some extent in some sectors, right? Look at the housing market. Home sales fell throughout all of last year. There was a bit of a rebound last month as interest rates came down, but we'll see what happens now that interest rates are rising again. So there's that clear sensitivity in the interest-sensitive sectors. But no, it's not bleeding broadly into the economy yet. And that's what we heard from Fed Chair Powell the last 2 days, is that they're going to continue to work to tighten financial conditions until they see that broader transmission, which means that they're on the path to price stability of 2%.